Welcome, everybody. I think this is now our third panel discussion we're going to have. And today we're lucky enough to have guests from pretty much all over the world, from London, South Africa, Canada, and myself in Singapore. So today we're going to look through we'll do a quick panel introduction. We'll go through questions for the panel and then come through to the summary. So starting today, we're going to introduce you to each of the guests. Maybe we'll take it in the order that's on the screen. Brian, would you like to give a quick intro to yourself? Thanks.
Thanks so much, Ned. My name is Brian Dunhill. I'm the founder of Dunhill Financial, not very originally named, but we are an American expat financial advisory firm. We're based here in London, and we take care of clients all around the world. Shiven, we don't have any in South Africa yet, so we might have to talk to you. But Robert, too highly regulated in Canada for us to deal over there. But we do Australia, we do Asia, all throughout Europe and the such. So we help with those American expat issues, and we're looking forward to working with a lot of the fintechs, including Bambu, to try to build the best robo-advisor so that we don't have to have minimums for those American expats.
There you go. And Brian, while it may not have been originally named, it's not a name you can forget who the boss is. So at least you got that in your favor. Great. Robert, if we can throw it over to you in Canada.
Sure. Thank you, Ned. So I am the lead portfolio manager for a team in Canada. We manage high net worth clients. So essentially, we're doing portfolio management, discretionary portfolio management, and wealth management as well. We're affiliated with a large bank, RBC, which is pretty much one of the biggest banks in Canada. We do have US clients. We have capabilities to portfolio manage in the US, slightly different regulation, as you would know, Brian, but we are licensed there as well. And so looking forward to share and happy to be on the panel.
And little known fact that we discovered just before the panel, at 22 years and 7 months, starting from an intern, Robert is the longest serving intern now employee, I would imagine, at the firm.
That's correct. I still think of myself as an intern sometimes. So that's the key.
As long as they're paying you more than the intern, Robert, I think that's okay. Sometimes. Great. And I told you we had an international panel today. We have Shiven in South Africa. Shiven, you want to give a quick intro?
Thanks, Ned. So I'm Shiven Moodley, based out in South Africa, currently a macro strategist and portfolio manager at Ella Asset Management. And we focus primarily on alternative investments, decentralized finance in the financial services sector.
Fantastic. And so, today we've got quite a range of businesses, from the American expats to one of the largest banks in Canada to Ella Finance, which in an emerging market and looking at decentralized finance. So let's move into the first and look at the first set of questions then. So these are the three different questions and the problem statements. The way that we're delivering advice is changing. Digital engagement is changing, and the way that we deliver this is changing all the time. So the questions that we're going to look at today is how we stay relevant. So these are the three questions to give you an overview. We're going to look at, we all talk about being customer centric. So let's talk about what is that number one thing in digital and in digital asset management that it matters most to your customer. We'll look at the different strategies we've used to address that clearly is a digital gap in wealth. And then we'll actually look at the solutions. So we talk about strategies and solutions. So let's jump on to the first question. Brian, why don't we start with you? You're dealing with American expats. America, I love America. It's an amazing place, but it can be a confusing place to invest, particularly from overseas. How has digital and how has your business evolved over these past few years?
Absolutely. The change has really gravitated in 10 years from a paper-based format into this fully online presence. It's only been really in the last year that we've been able to connect with all of our clients via remote access because we've had to. But the most important thing that I find that we've had to concentrate on is making things as intuitive as possible. And where it's not intuitive, be able to connect somebody on our team with those individual clients that are not having that intuitive process throughout in that process. Because essentially what might be intuitive to one of us that's financially minded might not be as intuitive to them as the client, yet we don't want to be condescending to each and every one of those clients. We also find that whenever we're trying to deliver, whether it be statements, an online version, online portals, or anything else, there's very much that Goldilocks paradigm that, sometimes there's a little bit too much information, sometimes there's not enough, and we're trying to get it to be just right. So we need to customize those for the different clients. If we're looking at sometimes our emerging affluent, our smaller clients that we know are developing up, we don't need to put all those financial planning tools in front of them right off the bat. We need to get the basics of investing in front of them. Whereas when we have our clients that are getting closer to retirement, it's probably more important to get those financial plans in front of them than it is all the details of what their investments are actually in. So it's customizing it, but getting it just right for that personalization. The last thing that I would say is so important to all of our clients nowadays. Now, I think the last time we polled, it was nearly 80%. It was in a high importance level for them of being socially responsible. And we need to start customizing those types of aspects, because it's easy to say we want to be socially responsible, but social responsibility to myself might mean that the environment needs to be put first, whereas other clients of ours will say labor relations or governance. So we want to customize their portfolios because this is their life's work that they have put together, and using the technology to do that is the best way that we can go ahead and arrange it.
Well, I didn't think we'd be talking about Goldilocks and having the porridge just right in terms of that. I heard a terminology someone used, because we've all heard of hyper-personalization, but they used a terminology that I think is relevant: customized simplicity. And I really like that idea, that it's got to be customized, but it's got to be simple, because if it's not, you're serving your customer something that isn't quite right. And I think that is so important. And Robert, clearly, being part of RBC, Canada's seen a lot of these robo-advisors are growing there. How have you seen your customers change? Are you guys getting it just right? Is the porridge just the right flavor for your customers at the moment?
Yeah, so there's been a lot of changes. I mean, since I started 20 some odd years ago, we've gone from more transactional style business to a fee for service business, which is essentially what the portfolio manager does. But that's not what's changed. What's changed is the expectations. Before I talk about that though, and what we're seeing as kind of like the most important things for these clients, I just want to tell you what our team is focused on, why we do what we do, and that's important. We're trying to make those clients that deal with us, we're trying to make them into, more aware, let's call it better investors, okay, generally. But it's a very general statement, but it is what it is. And anybody who's associated with us, or anybody who knows us, or listens to us, or watches our content and learns from us, we're trying to also educate those people. So why we do what we do is to make everybody better at investing, essentially. Now, how do you do that? Well, that's based on what the client wants most. So client wants something that's extremely optimized. So that's where you can use the typical tools. AI is helping us with trade execution now at RBC. We've invested a lot of money in that, but also we use some third-party tools as well. And you want to build portfolios that are extremely, efficient. So that's a given. But I think you can get that almost anywhere, right? So the key then is behavior, right? So the high net worth client has access to tools. They have access to, these are not emerging investors, right? They've been investing for some while, but now we need to elevate them to another level where the communication is extremely clear. I think you mentioned efficient. There was a word you just used, I couldn't remember, for the how much you show and kind of like,
customized simplicity.
Customized simplicity. That's extremely important. So what we see on the back end is obvious to us. What's not obvious is what the client sees, right? What they interpret. And remember, investor behavior is extremely important. So the key is to use, I'm gonna say, to use financial tools or to use technology to promote good behavior, is to promote the feeling that we don't need to use our emotions to make better decisions. That's what we're really trying to do. And I'll talk about some tools, I guess, later, and what we've developed to help our clients do that.
And I think this is, people talk a lot about financial education, but the reality is we haven't been great at it. I mean, Brian, well, Shiven will come to you in a second there, but Brian, like we did some research around financial planning in the US, and it seems something like 44% of people live a cash flow negative life. It's not something that's easy and obvious. It's got to be intuitive. And I think that's, something we've got to make people better investors.
Absolutely.
So Shiven, like you said you just started at a new startup. Everyone thinks that new startups always have the latest tech and we have the most customers. What's the reality? What is the reality of how your business, and you talked a little bit about decentralized finance as well. Give us that overview, because what do your customers want? Like, we're all customers of one, but we are in kind of generic cohorts, mass retail, mass affluent. It'd be great to hear from your point of view there.
That's true. I mean, startup culture is.
Oh no.
Again,
Shiven.
it's.
we lost you for 1 second, Shiven. We can edit that. Carry on.
No problem. So startup culture, I'll just start from the beginning there. So startup culture is exactly how we picture it. We're wearing hoodies and we're walking in and we're up and about. But the primary goal is obviously for our clients that are sort of coming into, are trying to understand decentralized finance and how crypto markets is sort of changing the way we look at investments, how tokenization is sort of the way we're looking at investment as well. And being in South Africa, particularly, there's a lot of inefficiencies in the market compared to Belgium and Canada. And we sort of see that in the market with decentralized finance and with a larger middle class in South Africa as well, trying to bridge that gap. So we saw a gap, particularly in a degree of savers that are traditional finance people. And as Brian said, they want something that elevates the high net worth individuals, want something that elevates their current portfolio, and middle investors really want to move from a space of traditional finance to relocate funds and just to be more confident in the application process of decentralized finance. And that's from the saver's point of view. And from the borrower's point of view, they're looking to get away from, okay, 100%. So just there. So as Brian mentioned, they're trying to elevate their client's portfolio with AI and tech as well. And that's what we're also trying to incorporate for our clients with third-party sources and sort of new AI tech that as we start developing and sourcing internally as well. But we're trying to just bridge that gap between the borrowers borrowers trying to understand decentralized application of finance with stable coins and how we can interact stable coins with sort of our Reserve Bank policy to either move money abroad, also make it easier to raise capital within the country for startups like ourselves as well. Sort of to bridge that gap. But quality of service is a priority across the board. I think whether wealth management and investment banking, quality service will be just a priority in all sort of business. And being a startup as well, that's key for us as driving business, especially new business.
Absolutely, it makes sense. And maybe as we move on to the second question, you mentioned that Belgium and Canada are efficient markets. I would love to hear from Brian and Robert if they think that's the case. And maybe Robert, are markets really efficient? Are people able to save and invest in the right way? I think, America, one of the most, where people invest all the time, there's still inefficiencies. And so, what are the strategies you use for this digital? I mean, maybe digital gap isn't always the right word, but what are the strategies? How do you think about it? How do you move it forward? We all know the customers want more, but how do you make it more efficient for them, Robert?
Yeah, so I think I'll talk about how we plan more efficiently, because I think the investing part in North America, whether you're in Canada or in the US, we have access to amazing tools, and whether you're building just a simple, portfolio driven by ETFs, or you're actually it's a quasi, half manager ETF, half individual holdings. All that's driven by the capability of the firm and the capability of the portfolio manager. Obviously, our portfolio management team is fully capable. So we do hedging, we do asset allocation, we do alts as well. Obviously not as active on the altcoin space yet, and that's normal because of regulation here, but also it's not only our firm, by the way, it's all North American firms that are extremely cautious, but recognizing the what's happening there. So I'd rather talk about the planning side, right? And so how do you bridge that gap? So everybody knows, you have online tools, right? Online access is essentially what's driving global business. And that's how we can have, clients everywhere. As my co-panelist just said, he has clients all over the world, which is awesome. And look at this panel. It's amazing. So the difference is what the client sees. So when it comes to digital enabling, I feel like we have it. What we do not have is digital visualization or coaching. So you do have a little bit of that. Some of the fintechs are starting to, where you can plot, okay, we're here, and if we do certain actions, we can be here, and the visual tools. But those are all driven by the inputs of the investor. When you have a portfolio manager or a wealth management team coaching and enabling and educating, we can help you understand the benefits of that visualization. So what we've done as a team, I'll talk about it. We've created a tool, and it's not only been over the last year and a half because of COVID, it's been something that we've had for about 6-7 years now. We've created an online tool for each one of our clients that's similar, and it's all based on the same fundamentals, but it's all optimized again, Ned, what you need to just for them. It's customized for them, right? And so that's our way of keeping them abreast, keeping them engaged to be a better investor, keeping them unemotional, making the right decisions. And it helps us as a team understand our clients better, because that's our visual tool. So it's a front end and back end tool, not only for us, because that's what most of the firms do. They have tools for the teams, the advisors. They don't have tools for the clients. This is a two-way tool, and so that's what we've created. And yes, there's a bit of maintenance to manage these, but luckily we have the capabilities and the team to do it. We hire very smart people. We'd rather hire people who are good at have skill sets than have finance degrees. So that's how we're managing the let's call it the digital aspect of how we're making our clients be better at investing.
Wow, sounds like you've put a huge amount of effort in there, and
we have.
Yeah, that's not just a weekend's work for sure. I mean, Brian, how does that resonate? I mean, I think look, we're all on the same path of making it digital, but how does that resonate with you guys? And I say with respect, Dunhill's, you're a smaller organization. How do you approach it?
Absolutely. And I think Robert identified some really key factors, especially amongst the younger crowd, when it comes to financial planning, to give somebody a stale piece of paper that all of a sudden you can't adapt any of the variables. It becomes something that you read once, you put it on the side, and it's not something that somebody wants to play with. Where all of a sudden, if you're able to get on the back end where the client can go in there and they can say, well, what if I go ahead and I send in 1,000 euros a month instead of 500 euros a month? Can I retire early? You get all these concepts. You keep hearing the FIRE concept, where you're going to put money away for a short period of time and retire really early. And all of a sudden, being able to give somebody those variables and give them the ability to play with them themselves, that gives them that great ability to conquer all of the obstacles themselves, but then come back with great questions for us to where we can get them over the hump. And we've done the same type of aspects on that, but we also want to make sure that our back ends are synchronized. To me, those silly little functions, I think we have over 12 fintechs that we have working on in the background. And half the time when we send something to the client, we ask them their name and their email address. Being able to just synchronize all of that, those aspects, make it so much easier for the client and make the experience much better for the client. So making everything sing together and work together is right now one of our big initiatives, so that we're not having to double up on functions.
Isn't it isn't it crazy that one of the things that seems so obvious that if you already have their name and address, it should be obvious, but it's still a challenge, right?
Absolutely.
I mean, Robert, do you do you still have, even in a huge organizations, you still have those little gripes and challenges about moving data in the right places?
Of course we do. Of course we do. And so we call it, there's, because our firms existed for so long, our banks exist for so long, there's layers and layers of technology that's been added. So legacy systems, we've tried to merge. It's very hard to merge. And it's very hard to start over from scratch because you don't want to lose all of the past data, even though we know that's all, you can do that. But there are, I guess it's the fear of starting from scratch. And I've recommended, I was on the board, the advisory board for our firm in our province, and I recommended that they start from scratch about 10 years ago. And they said, no, that's not going to happen. So why don't we use web-based tools to kind of get us where we need to be? So it's challenging, but I want to just talk about something Brian said. He said, anybody can do a plan and then the plan becomes obsolete, right? So we call that static planning. Right. So one of the things that we're trying to teach our clients is we do intelligent planning. So static planning is something that's done today. The minute the data is on, is provided to the client, then a decision can be made. But then all that data becomes stale dated, right? It's based on that particular moment in time. When you do active planning, every time there's an interaction with the client, there is a new data set because it's today's data. So now, whether that's pushed, which would be amazing if it's pushed into the planning software, or it's inputted by us, which happens in many cases, it doesn't matter. It's the planning happens as of today. And that's where the interactive, that's where you make people better investors, is by keeping them always updated, right? Always, it's fresh, it's today, it's now. That's what we're, Brian, you nailed it. I think that's how you're going to have better decisions. You're going to have less emotional decisions. That's how you're going to have better results. Increasing that 500 to 1,000 per month. All those things will help the client. I mean, that's tremendous. That's where we have to do a lot of our work. So yeah, and I'm glad Brian brought that up.
Yeah, I think we have to be on this path to make people better investors. There's my co-founder's working on something called predictive planning, and he likens it to the game of Go. In the game of Go, you've only got kind of two moves. You can move here or here. It's the same with money. In theory, you can only really spend or save it. I mean, I know it's more complex, yet we continually get it wrong. It's fascinating. There's only two moves: spend it or save it. Yet we get it wrong all the time. I mean, Shiven, how do you see it? Like, when you think about that strategy, obviously there's this whole new alternative investment side, but this idea of the inefficiencies that are there, do you think that the startups are curing them, or as Brian said, are we still stuck trying to work out what is the right, how we merge the data sets?
I think it's a tough question. I think I really agree with Brian, and I agree with Robert. I think static data, the way you're looking at it is, and then something changes in the market. And I mean, we saw that currently in the crash that Bitcoin had as well. And investors and some guys in South Africa that already have these funds are like, you know what, it's something that we're going to hold, but we're not looking at it as a perspective like that. We're looking at the technology behind blockchain and in blockchain and how it's going to simplify processes for us. And as you said, saving and spending as a way forward, it's 100%. I was actually chatting to, as a millennial myself, I pride myself on as being a millennial. And I was chatting to someone, and they're sort of in that space in life where they have the degree and now they're buying a property. And I'm like, have you ever thought about saving, renting for a little while, building enough capital and having sort of an investment saving? And they don't really think the longer aspect of it and diversifying their portfolio. But again, static data to the way the market is moving, to the way the market is changing. I think the pandemic definitely showed us that a lot of things changed, and the way we look at investments and the way we look at saving and the way we look at spending our general money, I think is a huge part on how it's going to restructure financial services as a startup. But from plugging, I would say, problems in the market, yeah, it was a different way. And I mean, from as you mentioned, Robert, the behavior of the investor and the behavioral sort of investment strategies in which you use. And how I look at millennials, and a lot of my friends are millennials and Gen Zs in the process, and they're looking at investment in the case of,
so why don't we do this just while we lost Shiven? We'll jump to question 3. And it seems quite similar to the kind of question 2 there, like what are solutions used to address? But one thing I've been thinking about is that, technology is better at anticipating what we want to watch on Netflix than anticipating about our financial needs. To me, that seems crazy. Like, has social media, has streaming TV worked it out? What solutions have they used that we're still struggling to? I fully understand that what TV you watch is less regulated compared to where you put your money, but the idea that we should all be able to save for a better future, the technology. I don't know. We had our own podcast at Bambu, and our very first show was called "Why Wealth Tech Sucks," which seems strange because we're a wealth tech. But what we were trying to understand is, why aren't we using the right solutions? What else could we or should we be doing? Brian, maybe I'll kick it over to you.
I think this is it's a wonderful question, because it's the question that will never get fully answered. The closer we get to it, we'll get new questions that come about for it. This last year in the pandemic, we had a great example. We've been on a 5-year trajectory to being a fully socially responsible firm. And yet when we had to move quickly, we jumped out of real estate and we went into e-commerce. Looking back at it, well, that was the obvious choice. But one of the companies that we bought in e-commerce was Amazon. Now, when I interpret social responsibility and ESG, I think of the environment mostly. Well, my clients told me very loudly that that was incorrect, and buying Amazon was not the right thing. They thanked me for the fact that they made a quick profit on it, but they weren't so excited about having Amazon. So we reflected on this in saying, we have not been asking the correct questions. We've been interpreting ESG in our regards. And we basically put out a questionnaire to all of our clients saying, what is your interpretation with ESG? So that we can try to decipher from one customer to the next what we should be buying inside of their portfolio and what should be allowed and what should not be allowed. Should we be looking more at labor, governance, or the environment for any individual customer? And we want to go even further down into certain regards to where if certain types of engineering or sciences are more important to individuals, that we can put a slice, but it doesn't affect the overall allocation of the portfolio, that we don't start taking too much risk on part of one client versus another, but that they can have a personalized portfolio that they care about. And that just means that we have to go off the model allocations onto some of the customizable effects, but bridging the two so that we're able to manage it on a bigger scale.
And you found that's resonated with your customers? You found that using that has made a big difference?
Absolutely. The more you start talking about the portfolio from what they're passionate about instead of just returns, well, first of all, they love it because they feel passionate about what's going on in the portfolio. But it's nice for us because we've got to remember 3 out of those 10 years, we're going to have to deal with markets going down. So if the concentration is that they're passionate about their portfolio, it's much easier to have those conversations.
I think it's fascinating. So I think we've all been benefits of what is, I don't know, a 10-year bull run now. And I have a feeling that robo-advisory might not have existed if we had a 10-year bear market, because no matter how good digital is, if you digitally lost 30% or, 10% a year for the last 10 years, well, you don't have much money left, but everyone's cheering on, oh, wow, hasn't technology been amazing? But, Robert, we've been in an environment that we've been allowed, like as Brian said, yes, by Amazon. Amazon's gone up. Okay, I don't want to make a profit. I'll trim my profit. I would love to hear how ESG people would be if they were losing money and how much is it going to come down. Robert, how in Canada? How do you see that? Same kind of view or different?
Yeah, so Canada is especially unique because we're, similar to Australia and some other areas, we're heavily, it's a country that has a lot of resources, a lot of companies in oil and gas. It is a big deal. And there's parts of our country that, they want to support the oil and gas industry, and it's very important to them. And our definition, I think generally Canadians' definition of ESG is different from other parts of the world. But Canadians are very environmentally conscious people. I mean, we live in a beautiful country, and ESG, by the way, let's not forget, it's environmental social governance, right? So it's a lot more than environmental. It's how companies run themselves. It's the boards. It's the way they select their employees. Are they an equal opportunity employer? All those things. Do they do good for society? Do they give back? So you can make a point that Amazon's evil, and then you could also make a point that Amazon's the best company in the world. So there's different ways to weigh ESG. But just going back to so I think we were talking more about how you can get notified. Let's go back to why don't we talk about the notifications, or being able like AI can tell me on Netflix that I should be watching Bridgerton, for example. Yep. Based on my previous it's a silly example because it wouldn't be telling me that, but it's telling my daughter to watch that.
It's okay.
Yeah, I know we all did. So and then it'll say, so based on what you watched, this is what you'd like next. You're absolutely right, Ned. What's the deal? Why are we so behind the eight ball? And my feeling is that in finance, it's because the information is much more, let's call it private. And I guess in Canada, it's very regulated. And is it because, we're not allowing AI to give us those recommendations? And that has to be the case. So I think that's going to change very soon. And I'm hoping it does, because we're looking, I can only do so much personal coaching. I would like also for the AI to help me execute those emotional responses or the right response for our clients, right? Remind them of the things that are important. Instead of me sending the reminder, I would like the AI to send that reminder. So I think that's where we need to go. And I agree with you, Ned. We're behind. And if anybody thinks, a fintech is ahead for that, it's absolutely not ahead. So I'm excited to see where, how things develop in the coming years.
I wonder if it's, Robert, to your point, I wonder if it's partly, you say, why haven't we done it? Wealth's been a high margin business for too long. People have made a lot of money with high fees for a long time, right? Because it is a complex industry, right? So there hasn't been the push to change, right? So maybe I think now we're starting to see, and again, I think COVID created this, there's no choice now. Like I think even 2 years ago, people used to say, oh, robos might not work, or wealth management might not go digital. I don't think anybody's talking that game, but I also agree, we don't want it to go digital and just digitize our existing processes that someone still has to press a button.
Correct. It could be dangerous to you need to have, it needs to be, we have to be the guide, or we still have a guiding, effect. And yes, it's high margin because it's anything that requires, anything that can cause a mistake from happening is worth paying for. Like you can say, oh, I paid less fees. But I can also show you, that those less fees, if you get worse returns and, worse responses to market events, that can cost, millions of dollars down the road for any client. So there is a fine line between paying for what you need and what you're getting. But just to go back to, the high margins, I don't think that's the case. I think it's because the wealth managers or the banks are fearful that if they start pushing too much information to the client through AI, that might cause clients to do things that possibly could disrupt planning or so there's, we also have to be, we want to limit how much the client is involved, because a client reads a headline, wants to act on the headline. That's not necessarily the case. The reason why Warren Buffett is one of the richest men in the world is because it doesn't act on headlines, right? So these are the kind of things we need to promote. So it's a fine line. I think the planning side needs to have more AI, and the investment side, I would say that we are too short term generally, and it's become worse, by the way. And Shiven talked about it. The things change a lot. Yeah, but the problem is the young investor thinks that they need to trade more. You don't need to trade more. You need to accumulate. And some are they're holding, right? Then we're holding this long term. But we see the behavior as that's not actually the case. We see a lot of trading. We see the volatility is caused by people buying and selling. and being home, Ned, being home, because you couldn't go out for the last 12 months, and in some places you still can't go out. They have time to do this trading. So I don't want to get too much off topic, but I thought that could be disastrous also for us.
There was a Forbes article, and I'm paraphrasing, but it said people stayed at home for 12 months. Stock markets went up. Why are we surprised they treated it like a game? We put people in front of screens with markets going up and kept them at home. Why is anybody surprised? And interestingly, we had a client who came to Bambu the other day and had an idea for a robo-advisor. I do not think the regulators would allow this, but what he said, the idea was, why don't we just gray out the sell button? Like, just don't let people sell, right? The portfolio should be Warren Buffett. Warren Buffett doesn't sell, right? It's not a secret strategy. Just don't sell. It might not be. But Shiven, sorry, we lost you for a little bit there. So maybe coming back to you, I think as Robert said, the millennials are maybe unfairly taking some heat for how they've changed, because there's trading and investment clearly. And I don't think we want to stray into the whole GameStop craziness, because that's trading. We're talking about investment, but maybe give us your perception. Like, clearly there's benefits of using technology in investment, but are we at a dangerous place, do you think, right now?
It depends on the type of. Also emphasized, it's the mindset, but also the psychology is short-term investment. It's, I'm going to pump and dump the stock 100%. So again, I would say it's the psychology of the millennial and also the young investor that's coming in. And I think with Reddit and Twitter and the whole psychology, everyone's like, we're going to pump and dump this stock. And obviously we saw that in AMC and in GameStop. But in the alternative investment space, we saw guys in particularly South Africa that are trying to take advantage of the arbitrage in the difference in price. And that's what we're doing, particularly with AI and locking in future rates, and particularly with stablecoin. We tend to avoid the major cryptocurrencies and use stablecoin to take advantage of the arbitrage with AI and investment. And that's been successful for the guys that traditionally want to be in the crypto market, but also following regulation and sort of the investment allowance under the South African Reserve Bank to take advantage of these, I would say, small income and risk-free alphas in the market as well. But again, primarily we've seen, and as sort of a millennial, it's the mindset, it's the traditional, I would say Warren Buffett. I had a gentleman that come in the other day and he said, you know what, my portfolio, I want it to be like Warren Buffett. Fundamental analysis, and that's how I want to look at it. And he's using the right method, and it's the long-term investment and a long-term strategy because he's a young guy. But again, some guys, the millennials, just want a quick buck, and that's obviously quick in and out in the market, and obviously following the Twitter and news headlines give you sort of that pump and dump psychology.
We lost you just at the end, Shiven. Well, I think we can take that. I mean, maybe as we move towards the summary, maybe Brian and Robert, what do you think we are? Do you think markets have changed forever? Do you think investment has changed forever? And what we'll do is maybe we're coming towards the end of the panel. Maybe give a minute or two to give maybe just a summary, where are we in the whole changing of digital wealth? What is the summary? What's your kind of thoughts of where we are now and where we're going in the next 5 to 10 years? Robert, you want to go first?
Sure. So I think we're at a good place right now. And like I said, it's all about behavior, right? So I think we're getting a lot of new investors. We talk about millennials a lot. That's a good thing. When I started, it was markets were at all-time highs, was .com, and we were trading in the classrooms, but we were calling up and we were trying to there was dial-up back then, but we were able to trade. I mean, we paid for trades back then, but it was still marginal, very, very low. Now they're free in many cases. But all that to say was that stayed with us. Okay, so my cohort is everybody in my cohort, my age group is now investing, and they're investing wisely. Not always wisely, but they have experience, and they were risk averse for a while. And I would imagine that's going to happen here as well if people make suboptimal decisions. So what do I see happening is I see that cohort becoming very engaged, which is good because there's going to be huge pass-through wealth over the next 20 years. And by the way, the millennials are one of the biggest cohorts since the baby boomers. So that's another good thing. So this bull market will be around for a while. But you're right, Ned. When we have a bear market, I don't know how well robo will do. But to be quite honest, I don't know how well traditional will do either. So I think it's a fair match. It's a fair game. I do think that eventually, we are used to these devices sending us notifications. We are used to having information readily available. We are used to having decisions helped by AI. This has to be the standard in financial services. If it's not the standard, that those providers will be eliminated. So this is where we're going over time. I think people generally are emotional. I think if they can, they can be coached and the tools they're using remove that emotion, they're going to be much better investors. And remember what investing is all about. It's all about time in the market, compound interest and time in the market, and making optimal decisions and planning. And by the way, like anything in life, fail to plan, plan to fail. So if you can do those 2-3 things correctly, it's simple things. It's not, well, what's the best, crypto going to be? What is the best stock going to be next year? It doesn't matter. In the end, you have to have a process. You have to be investing. That's the key. And if we can enable clients with technology to do all that, then we've won. And that's what our goal is, and that's what we're trying to achieve. So I think that's my takeaway. And I see it's going to get only better from here.
It's a great summary. I'm with you. I think there's just going to be massive AUM kind of growth because, hey, look, when I was 21, I didn't have any money. I'm a bit older at 54. I didn't have dial-up. I didn't know how to call a broker. I just didn't have any way to invest my money. Just couldn't do it. So I didn't do anything. So I just frittered it away, which was still fun, but not very good for planning for the future. Brian, what's your kind of summary of where we are today and what the future holds?
I think Robert hit the nail right on top of the head, and behavioral economics are going to really drive those same tendencies. I don't think technology really changes us as human beings. It speeds things up. So we end up doing the same silly things. Think of the tulip trades 400 years ago to Bitcoin today. I might have offended some of your viewers right there, so I apologize. But at the end of the day, we're going to behave in those same ways. I think technology is really going to help us go more from the financial planning model of yesteryear, where we all showed up in our fancy suits, et cetera, to more of a gym model, where we're going to have that accessible point that's pretty much $10 for the month, and then you're going to have that personal trainer, and everybody's going to have those access points. And I think that's a wonderful thing that big institutions, small institutions are going to be able to offer both of those different service levels to help people get better organized and make finance accessible to everyone, just like fitness is accessible to everyone.
I love that analogy. The only question is then, fitness gyms soar after New Year because people have eaten too much. I wonder if we'll find some analogy whereby people will rush to finance apps at a certain time.
We actually said that exact thing in our January economic update, that everybody was going to be rushing to do their financial plan just because it's the beginning of the year. And I don't know about you gentlemen, Shiven and Robert, but we had a very busy time up until May. And I'm expecting it to die down over summer. Maybe that's just a European function of everybody disappearing for the summer.
You normally just sell in May and come back in November.
Well, and Shiven, I know the Wi-Fi's been a little unstable there, but hopefully maybe we can get a minute of it stable now. Yeah, what's your view? You've got the. I mean, I don't mean to be a rude to Brian or Robert, but statistics would say you've got the longest to live, so you have the most to go for the future. That's just a statistical thing. I don't know if it's. I don't know. We'll find out in the future. If it's true. But what do you see in the next 10, 20, 30 years from your vantage point?
I think. Just regarding, I think, financial services and just being in the industry in financial services, in the last 5 years, it's changed drastically, particularly in the treasury space. And I think in the next 5 to 10 years, we're going to see what a ease of transaction across the board. But also, I think with central bank coins coming into play, it's also going to shake a few branches, because obviously with privacy settings, and the central bank knowing exactly where your money is going as just an individual, I think privacy will be a huge dilemma coming into the future of particularly alternative coins or any coin in that sort of sense. But definitely blockchain is here to stay from our point of view, and financial services is hopefully we can adapt it in a way that is going to streamline payments and streamline treasury as a whole. So definitely the future is looking bright, and hopefully I can see Brian as well as Robert in the next 5 to 10 years.
That would be great. Exactly, that's great. Well, look, we summarized with some blockchain future that finance will be like going to the gym, and I think Robert's point that's never changed. Planning. If you fail to plan, you plan to fail. And the reality is, I think that technology means it would almost be impossible not to plan, because technology will have the data and it will say to you, I think the end game, and my just last comments would be, I think at some point, I wonder if the machines, as we all call them, will get to the point where it will physically stop you from spending because you're not saving the right amount this month. It will stop you from doing bad habits, because that's the problem with humans. We're really bad at self-policing ourselves for habits, which we still know can be the wrong one. So Brian, Robert, Shiven, thank you so much. I really appreciate your time on the panel, and thank you to everybody, and we look forward to speaking to you again. Thanks, everybody.